Payslip confusion. Here's the stuff you need to know to read your payslip. In this video, we'll break down income tax, national insurance, and other deductions that might come from your payslip. Ever wondered why your payslip isn't as big as it should be, or why the hell you're paying national insurance? You agreed to a salary of £45,000 and you get paid monthly. You know that, right? So then £45,000 divided by 12 is £3,750. So that's what you should get in your bank account every month, right? But that's not the amount that hits your bank account. Did they just get it wrong, or are you being conned? Let's clear that up in this video today. When you get paid in your job through a payslip, some deductions are made from your money before it reaches you. These deductions are taken from your wages before you even see them. But do you really know why? Over the next few minutes, you'll start to understand why. You must have looked at your payslip, and to some degree, all of us have when we first started out in the big bad world of employment, when we got our first jobs. I remember looking at my payslip and thinking, what the hell is all this? Between tax codes, income tax deductions, national insurance, it can all feel like a foreign language. But once you break it down, it's really much easier to understand. So let's dive into what income tax and national insurance actually is. First, let's talk about income tax, the most common deduction in your payslip. So what is income tax? It's money taken from your earnings to fund public services, things like healthcare, education and transport, and a multitude of other things that governments provide. In the UK, income tax is based on your earnings and the tax bands that you fall into. Here's how it breaks down. Just before I dive in, you should know that the tax rates I'm about to explain are accurate as of now, early 2025. If you're watching this much later in the year or even in future years, the tax rates I'm explaining might not be as accurate today as they were when I recorded this video. You get something called a personal allowance, and that's £12,570. This is the amount everyone in the country gets to earn before they pay a penny of income tax. It's effectively your tax-free amount. Then comes the basic rate of income tax. This comes after your personal allowance of £12,570. You pay 20% income tax on your earnings between £12,571 and £50,270. Then comes the higher rate. If you earn between £50,271 and £125,000, then you pay 40% tax on that income. Then comes the additional rate. For income over £125,000, you pay 45% tax. So for example, if you earn £35,000, the first £12,570 of that is tax-free. The remaining £22,430 will be taxed at the 20% basic rate, which means you'll pay £4,486 in tax on that amount. Now let's take the example of someone that just slips into the higher rate of income tax. Let's say you're earning an income of £55,000 a year. So if you earn £55,000, the first £12,570 is again tax-free for you. The next £37,700, the basic rate band, will be taxed at 20%. This amounts to £7,540. And the remaining £4,730, the higher rate band, is taxed at 40%, which amounts to £1,892. So in total, you'll be paying £9,432 in income tax. So that's a basic whiz-through of the income tax effects on your payslip. Now let's tackle national insurance. This is another key deduction on your payslip. Now in theory, you pay national insurance to contribute towards state benefits, like the state pension or unemployment support. But these days, national insurance along with income tax is all bundled together and then divvied out according to government priorities. But what you really want to know is, how does national insurance affect your payslip? If you're employed, you'll pay Class 1 national insurance contributions. And this is where it gets a bit tricky, because national insurance is based on your weekly earnings, even if you don't get paid weekly. It's a bit antiquated, but let me explain how it works. You pay 8% on earnings between £242 and £967 a week. And on anything over £967, you pay 2% on everything above that. So for example, if you earn £500 a week, you'll pay £20.64. That's 8% in national insurance contributions. And if your weekly earnings are over £967, you pay 2% on the excess. And it's important to understand that national insurance doesn't always work exactly like income tax does, because it's calculated on a weekly measure. And that's true even if you get paid monthly. National insurance payments, or NI, is crucial because it determines your eligibility for future benefits like maternity pay, paternity pay, or the state pension. It also contributes to social care services. So whilst you might not see it now, it might be something that benefits you in the future. Now let's take a deeper dive into your payslip and decode everything you might see. Here are the main components. You might see gross pay. This is your total earnings before any deductions. It includes your base salary, plus any bonuses, overtime, or commission you make. Then the biggest deduction will almost always certainly be income tax. tax. This will be clearly shown as a deduction based on the tax bands we just discussed. It's typically shown as PAYE, pay as you earn. So this tax is automatically deducted by your employer and passed on to HMRC. Then comes national insurance, and just like income tax, NI contributions will be listed as a separate deduction on your payslip. The amount will depend on your weekly calculated earnings. You might then see pension contributions. Many companies will automatically deduct money for your pension plan. This is typically shown as a separate entry. While it's a deduction now, it's an important one because it helps you save for your retirement. It's money that you can call on in the future. I've done separate videos on ISAs and pensions, so that's something you might want to look at later. And I'll link to it up here somewhere. You might also see student loan deductions. If you're paying off a student loan, then this might be listed as a separate deduction on your payslip. The amount deducted will depend on your income level and the type of student loan plan that you're on. Then after all of that, you get to the magic number, the net pay number. This is the money, known as take-home pay as well, that you actually get after all those deductions. It's your actual pay after income tax, national insurance, pension contributions, student loan deductions, and all that. Again, let's look at an example here. Let's say your gross pay is £2,500 a month. After income tax, national insurance, and pension contributions, your net pay might be around £1,800 a month. This is the amount that actually gets deposited in your bank account. Now that you understand how income tax and national insurance affects your payslip, the money you take home from your job, the money you take home from your employment, let's also consider how taxes might affect your savings, particularly the interest on your savings accounts. Now again, this information is valid as of now, early 2025. If you're watching this much later, the numbers and the percentages may have changed. The government currently gives everyone a personal savings allowance. This is the amount of interest you can earn from a bank or building society without paying any tax. And this amount currently stands at £1,000 for basic rate taxpayers. For higher rate taxpayers, it's £500, and additional rate taxpayers get no allowance at all. Now for me, the personal savings allowance really doesn't matter because all of my savings, all of my investments go into an ISA. An ISA is an individual savings account which can keep your money in cash or in investments, and the important thing is it all comes with a tax wrapper around it. So any money that you earn within the ISA is tax-free. There's no allowance. Everything you earn within there is tax-free, regardless of your income level, whether you're a basic rate taxpayer, a higher rate taxpayer, or an additional rate taxpayer. Whether it's a cash ISA or a stock and shares ISA, the interest, growth, dividend income, whatever it is that you earn within that is not subject to tax. If you earn any interest outside of an ISA, then your personal savings allowance comes into play. And any interest that you earn above your personal savings allowance will be taxed at your usual income tax rate. So here's a quick example again. If you earn £1,200 in cash savings interest and you're a basic rate taxpayer, then you'll get to keep £1,000 of that completely tax-free. The remaining £200 will be taxed at 20%, so £40. But if you'd kept all of that £1,200 within a cash ISA, for example, or a stock and shares ISA, but let's go for cash ISAs for now. If you'd kept it within an ISA wrapper, none of it will be taxable. All of that interest would be tax-free. I hope this video helps you understand your payslip that little bit better. And if it did, be sure to hit the like button below and share this video with your friends. You never know how this simple gesture of sharing it on your socials could help someone. And if you want to continue your own money basics journey, then this is the video you want to watch next.